Manish Gunwani joins us, Head of Equities with Bandhan AMC. Manish, good morning. Thank you for joining us. What do you make of the construct of the market? We had a scary fall on Monday and looks like a lot of collateral damage has already been done.
Well, I think I would prefer to be a bit cautious. I think there are a lot of returns being made in cyclical sectors. And tactically, I think one is valuations, two is the Indian rupees also outperformed a lot. Um, Three is given the election result, I think the policy focus is still to be seen. So overall, I think in a bull market, there are periods where one needs to be tactically cautious. I think we'll go through some consolidation. I don't expect any big drawdown because liquidity looks fine. I think the dollar has a bias towards weakening rather than strengthening. So as long as one is negative on the dollar, I don't think you can be very bearish on the market. But yes, we are also seeing a lot of supply, IPO pipeline, QIPs, etc. And therefore, I think it's very healthy for the market to go through this because no one wants extreme boom bust kind of cycle. So I think probably the best thing to happen for the market is just go through a consolidation phase. And I think that's what hopefully we'll see.
Right. That's the thing, right? There is no method to the madness, given that every dip gets so swiftly recovered into, and even the weakness on Monday, Manish, has hardly lasted. What is it telling you about the appetite, at least by the Indian domestic investors?
So our view has been that structurally liquidity looks strong for Indian equities, both from a foreign perspective and from a domestic perspective. I know foreign flows to equities have been patchy, but I do think that as a country across various asset classes, foreign flows are coming in, which is why you see forex reserves doing well. So I think globally the issue is that in fixed income, there is hardly any real return, right? So whether it's Japan, US, or India on a post-tax basis, um, savers are not able to beat inflation using fixed income. And I think as long as that issue remains, um, or we see something which hurts global growth or domestic macro growth very badly, like COVID, which we can't model, till that happens, I think unlikely that we will see a big drawdown.
I'm looking at your top declared holdings, Bandhan Core Equity, Bandhan Flexi Cap, Bandhan Innovation. Now, at least the declared holdings are indicating one simple pattern, which is that you don't have too much of ownership in PSUs, whether it's banks, metals, railways, or defense. Why is that?
No, first of all, we do have PSUs, just that I don't trust any single PSU too much because the government has a habit of changing regulation periodically. So one is to have a string of pearls in PSUs, 1.5% kind of holdings. But yes, I'm not overtly positive. So if you break PSUs into different buckets, I think defense is very expensive. The margins are high. The market caps look very high versus global comparables. So we're not there in defense too much. Even on energy, downstream and midstream, we are not there because there is too much capex happening in those companies. And generally, PSUs, when they do large capex, the profits don't grow too much. We are there in upstream oil, and we're there in power-related value chain, which is the financiers and the equipment makers. So we're selective, and I do think, obviously, that valuations have gone up for most PSUs. So they're not as attractive as they used to be. Yeah. So yeah, we're not extremely bearish. We're not extremely bullish. Somewhere in between.
Manish, I know you can't talk about individual names, but just a theme at large. What is it that you're making of the kind of valuations some of this new paper is coming in with? I mean, case in point being even, a first cry, or for that matter, Ola Electric. Loss making, but coming at peak market as well as IPO pricing.
Actually, and again, this is not a top-down view, but I think internet-related names are one of our bigger overweights right now. So if you see our bigger overweights right now, it's healthcare, internet, and telecom on the defensive side. And on the cyclical side, it is real estate and power capex-related stuff. Incrementally, actually, the first bucket has gone up over the last 3-4 months. So coming back to your question about internet names, I think one needs to keep an open mind. I don't think, look, theoretically, the next 3 years' profit on a discounted cash flow valuation really don't matter. But having said that, when a company is loss-making, you need margin of safety. So when you are projecting profits 5 years, 7 years out, you need to buy it at a point where it's extremely cheap. Because obviously visibility for next 2-3 years is a bit murky. So you need to be very clear about unit economics and this scalability of the model. So I don't think we will dismiss all these names just because they are loss-making.
Everybody likes private banks, yet they are not moving. Nothing wrong with the numbers, time-wise correction has kicked in, but what is the reason why these stocks are stuck?
I think it's cycle versus valuation, and generally in my experience, cycle wins. That whatever be the starting point of evaluation, like for a commodity stock, it always goes up when commodity price goes up. Doesn't matter on EV, EBITDA, whatever, right? Broadly. So the point with private banks or banks in general today, I think, is you're seeing these numbers at the best credit quality virtually ever. I mean, maybe 20, 30 years, best quality ever, right? Now, if you are a bit of, if you believe in cycles, you shouldn't buy banks now because banks are to be bought when there is a macro problem which translates to a lot of big credit cost. So you don't have that right now. Now I know that price to book, price to earning multiples are very attractive. So I'm not underweight, but I'm just trying to be a bit more value focused in the sense being lower price to book, because if credit quality sustains at these levels, I do think that that convergence of lower price to book financial will still happen a bit. Although again, that trade is 2 years old. There's not too much room to go for that trade as well. So it's a very tricky situation where valuations have actually derated versus the market, even while numbers have come out fine. But the point is, going forward, will these numbers, will this pristine asset quality sustain? If you believe in cycles, it will not.
Okay. So do you think the cycle has turned for IT? Has the cycle turned for FMCG?
IT, not 100% clear. FMCG, at least downside looks lower. There's some green shoots on rural with Narega days and all coming down. But yeah, there could be something tactical there. But having said that, both these sectors, I think, are too big to give you the big return, in the sense that, see, no one's expecting US to accelerate and, IT large caps to grow at double digit in dollar terms. So a best case is you need to be a bit tactical, play for 15-20% upside in a lot of these names. But yeah, don't see downside in both actually. I don't think IT also has too much of downside.
Manish, do you also think that that time has gone when you could take concentrated bets on either large caps or SMIDs, and now you need to have a more diversified equity portfolio?
Broadly agree, especially if you're managing large amounts of money. If the amount of money is small, maybe it can be very concentrated. But I do think that both the macro is changing fast and the price discovery is changing faster, right? So the whole concept of buy and hold, I don't think works right now, at least in this phase of the market, because um, if you have a differentiated insight, you are getting the return or the punishment so fast. But basically, whatever upside is there for next 3-4 years, it gets captured in 6 months. So I think it makes sense to be nimble and keep rotating sectors or stocks based on better risk reward.
So where do you think big money would be made if it is not IT, if it is not PSUs, if it is not cyclic, if it is not FMCG? Where big gains could be made in next 2-3 years?
No, I'm saying that it will be made in smaller names in all these sectors and some others like healthcare or internet or whatever, or even some PSUs maybe. But all I'm saying is, uh, look, we're living in a world which is getting Japanified. So I don't believe structurally very large market caps unless they have a technology or a non-linear business model, which Indian companies will not have at this stage. I mean, we're not talking about Nvidia or Apple at this point of time. So for a normal business model to create $500 billion, $1 trillion, very difficult. So I think we're obviously going through a lot of change. So a lot of smaller companies, whether it is healthcare, engineering, auto banks, internet names, there are a lot of choices there. I know the small cap space is generally expensive, but if you're living in a world with very low growth and high liquidity, I think the alpha will be in terms if out of those 500, 700 names, you get a good set of 40, 50 names. That's what will work, I think.
Right. Okay, Manish, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
Thanks a lot.